No voiceover?
Welcome to The Explainer. Today we are tackling a question that's probably on a lot of your minds. Are you paying way too much tax? We're going to dig into why that happens and, more importantly, how you can start thinking like a tax-savvy business owner. All of this comes from the brilliant insights in Chapter 1 of Evelyn Jack's book, Make Sure It's Deductible.
So let's just dive right in, shall we?
I mean, this is the million-dollar question, isn't it? For so many Canadians, especially if you're like most people earning your income from a single job, the answer is, yeah, probably. It's so easy to just see your tax bill as this fixed thing you can't change, but, it really doesn't have to be that way. And this slide, this right here, gets to the absolute heart of the matter. Most of us are reactive. The CRA sends a bill and we pay it. End of story. But the real key, the big shift, is to become proactive. It's about thinking about tax efficiency and making smart choices with your money all year round, not just scrambling in April. Okay, so how do we start being proactive? Well, the very first step on this journey is to really wrap your head around how you're actually taxed. Now it is absolutely crucial to get the difference between these two rates. Your marginal tax rate. Think of that as the tax on your next dollar. You get a raise, you do a side hustle, that's the tax rate on that new money. Your average tax rate, on the other hand, is the big picture. It's your total tax bill divided by your total income. It's what you actually paid after all your deductions and credits are factored in. You gotta know both to play the game smart. And this simple phrase pretty much sums up Canada's progressive tax system. As your income grows and you climb into higher tax brackets, that marginal rate goes up. Understanding this principle is totally essential if you want to make smart decisions about how you earn your money. Now here's where things get really interesting. This is a game-changing idea. The government doesn't treat every dollar you earn the same way. Getting this is a huge piece of the tax efficiency puzzle. Just look at that number, 50%. In Canada, when you have a capital gain, the profit you make from selling something like stocks or a rental property, only half of that profit gets added to your income for tax purposes. That is a huge advantage compared to your salary, where 100% is taxable. And believe it or not, it gets even better. We have this incredibly powerful tool in Canada called the capital gains exemption. For entrepreneurs, this is a really big deal. For example, when you sell shares in a qualifying small business, there's a lifetime exemption worth hundreds of thousands of dollars. We're talking a massive chunk of profit you can earn completely tax-free. So let's put this all together, right? If different types of income are taxed at different rates, doesn't it just make sense to earn different types of income? The answer is a huge yes, and you can absolutely use this to your advantage. This is where the real strategy kicks in. When you start diversifying your income streams, maybe adding some business income or investment gains to your salary, you can actually pull your overall average tax rate down. It's an amazing concept called tax cost averaging. Okay, let's make this super clear with a quick example. Check this out. In scenario A, you've got someone earning an $80,000 salary. Simple, straightforward, all of it taxable. But now look at scenario B. This person also has 80 grand in their pocket, but it's made up of a $60,000 salary and a $20,000 capital gain. Because only half that gain is taxable, their total taxable income is only $70,000. Less taxable income means a lower average tax rate. Simple as that. So what does this all lead to? Well, it all builds towards a new, much more empowered way of thinking about your finances. It's about asking the right questions and totally changing the conversation you have with your advisors and with yourself. This is what being proactive looks like in the real world. You're not just dropping off a shoebox of receipts at tax time anymore. You are in the driver's seat of your own financial future, asking these kinds of smart, strategic questions all year long. And honestly, that's the ultimate goal. You start weaving tax planning into all your financial decisions. It becomes a key factor when you think about your investments, your business structure, how you pay yourself. It's not just a mad scramble once a year. So, as we wrap up, the biggest takeaway is this. You have the legal right to arrange your finances to pay the least amount of tax possible. This isn't about tax avoidance or finding shady loopholes. It's about tax efficiency. It's about being smart. Gaining this knowledge is the first step. The real question is, are you ready to take control?